All right, folks, this is being recorded. And of course, like a broken record, some of you that have watched this entire course hear me say this every single time, but watch this again because I teach this a little bit different than most people. I'm going to give you guys specific strike locations, specific days to maturity that we're going to be looking at, all of those things that go into the long call calendar in order to increase your probabilities of success. That's my focus for you all, is that to create a streamlined process for anyone to follow in order to find the right option strategy for any given assumption. And that's ultimately what we do when we are trading on a daily basis, is we come up with our assumption before we really know what kind of strategy we want to put on. So that's how I've geared this course, is to kind of go through that process of what we would do on a normal daily basis. And the idea here is, once we come up with our directional assumption, is we go down this roadmap. Sometimes when it looks like it's high volatility, we're going to take our left. If it's low volatility, we're going to take a right. So all of those things are going to culminate in finding this right option strategy for this given assumption. Looked up on CNBC. I don't know what you're talking about, Jeff. Oh, Ford looked up. You've looked up Ford on CNBC. I haven't seen it come out. I have that in my IRA. That's why I was asking. And supposedly they're doing really well with the F-150. All right, so let's get on with this. But let me get a couple things out of the way real quick. My name is Eric Wilkinson. You guys, like I said, may have recognized me from mainstream media, where I talk about the economic data, geopolitical environments, all of those things coming in to impact the markets, and how my market analysis is based on that. I traded in college, moved to Chicago, started working on the Chicago Board of Trade's floor. And as a trader from college to now, I've traded everything from stocks, financial futures, commodity futures, currencies, and options on all these products in just about all market conditions. I see Jeff is all over it for me. I'm going to have to wait a second. All right, so we're going to be doing this webinar on the long call calendar. Long call diagonal. We did the calendar last week. What's going to be the difference between the long call diagonal and the long call calendar? Well, we're going to break that down all the way down to what would be slightly different from our assumption as well. So with that being said, let's move on to put this on a shelf is really what I'm getting at here. Forget about the fact that we're doing the long call calendar or long call diagonal even, because I want to find ourselves looking for that rather than to cherry pick that strategy off the top. So what we're going to be looking at today is directional assumption. So we're going to come up with our directional assumption first. In this case, it's probably going to be one of the simple ideas, is that we think that this market is going to kind of continue to trade a little bit higher. We're not looking for a hockey stick kind of move. We don't want that. We would rather see a slow kind of trajectory, just kind of churning along. So, you want kind of your boring stocks here, and that's going to be one of the ones that fits the best. The destination, this is the stock, all right? Stock is the destination. Ultimately, what we need to know is, are there a bunch of eyeballs on the stock? Are people watching this stock? Is there participation? Are there a lot of people trading in the options? Not necessarily the stock, okay? But the stock options is really what I want to key in on. Are the stock options tradable? And then the environment. We need to know where implied volatility is in relation to where this underlying has seen its own implied volatility. And we'll talk about that, because we're not talking about the VIX. VIX is more of a broader market gauge of volatility, but every individual underlying has its own implied volatility. And we need to really hone in on that in order to discern what's going on in the option montage. Because what we're trying to find out is really, are we looking at expensive premiums or cheap premiums? And this is what is going to tell us ultimately what type of strategy we're going to be looking at. Because if volatility is high, that means environment is elevated, and therefore those premiums are elevated. So we'll be talking about all of that. And days to expiration, the duration, what duration options days to expiration, and the options are we going to be looking at, and specifically strikes. I'm going to be talking about what delta strikes we should be looking at. So you go online, they're just going to give you broad strokes. I'm going to talk about specifics. Why? Because I believe that during my 25 years of trading, I've streamlined this process for you, and that every assumption has its own option strategies that would be associated to that. Sometimes it's going to be selling a call spread. Sometimes it might be buying a put spread for that same directional assumption. It will all be based on what's going on in the environment. That's going to be the determining factor, really. So we're going to hone in on that quite a bit here today. But a couple of things I want to talk about here is our roadmap key. This really is going to be what we need in order to find our way to our destination when you're looking at a roadmap. But ultimately, what we need to do is that little insert down in the corner of any roadmap tells you what kind of roads they are, what the distance is. And that's kind of what happens here in our option montage, which is that page that has all of the things going on in it, this page here. But delta is data. All right. So on the floor, we used to say it's data. Why? Because it gives us all kinds of information, probabilities and everything else. But the thing I want to key on right now is how it affects our options premiums in relation to that underlying. So when we're talking about delta, we're talking about a dollar move, $1 move. And all of these Greeks are going to be associated to like a one tick move, if you will, like 1 day, 1 percentage point, and $1 in delta. So when the underlying moves higher by $1, that delta number, which is, you know, we have calls and the puts, right? We have calls and puts, and then there's going to be a delta number, and it's going to give you a decimal point of like 0.45. That is going to affect those options premiums in relation to that. So right here, we've got the delta. We've got the underlying trading 148. Now, if it went to 149.35, just $1 move higher, we could go down here and look at all of these delta numbers and add those in. I don't want to make that look like a negative, but basically these are all positive. So if it moves, if the underlying moves higher by $1 increment higher, then our premiums would increase by the corresponding delta. Now we'll notice over here on the put side, right? The put side has a negative delta associated to it. That's because if this underlying moves higher by $1, we would lose 38 cents out of the corresponding puts. All right, so that first dollar move, we would see those puts, first dollar move, we would see those puts move down by the corresponding delta. Now, flip side of it, if we had a negative move, right, a negative dollar plus a negative delta, then if we started moving down, these premiums would start increasing by that corresponding delta. And if we started moving down, a negative dollar plus a positive delta would make that a negative delta, right? Same thing over here, a negative dollar. If we went negative dollar plus a negative delta, those would become positive deltas. Pretty simple so far. Now, gamma goes with delta. All right. We talked about delta being the first dollar move. Well, then that would mean gamma is the second dollar move. So on that second dollar move, we see gamma adding in to that delta premium. So here now we're talking about $1.50.35. So exactly, I'm keeping even the pennies the same, right? I mean, I could even go 0.5 if you really wanted. But bottom line is we just talking about a full dollar move higher. So now this is dollar number 2, right? Move higher. So now in this case, we looked at the first dollar move. We had a plus dollar move plus 45 cents. We went to 405 and 420 on the offer, right? Because basically I added 45 cents to these premiums. All right. Now we're talking about the second dollar move. So this gamma goes with that delta. And now we're talking about 48 cents adding into our premiums over here. So we would be looking at $4.53 on the bid, right? And on the offer, we would add 48 cents to 468. All right. So if the underlying moved higher by $2 and nothing else changed, we would see this happen to our premiums. And again, if we had a second dollar move higher, right, then we would see gamma goes with delta. So the second dollar move higher, first dollar move, we lost 38 cents. So we would have been looking at $2.62 on the bid, right? And then $2.72 on the offer. Sorry, 72 cents on the offer. Now, on the second dollar move higher, we only lose 35 cents out of this trade here. So we'd be looking at 227, right, and 237 on that second dollar move, okay, because they only would lose 35 cents on that second dollar move there, all right? Flip side, we start moving down by $2, then that gamma would add into that delta, all right, on that side. And same with this, if we move down by $2, we would have a negative delta plus a positive gamma, all right? Everybody on that? Jeff, I haven't been able to read over that yet. All right, theta is the thief in the night that comes and steals our premium. So basically, it's the impact of time on our premium. Now, like I said, all of these are assuming a move higher. Delta is moving $1 higher. Theta is the thief in the night, and it is the impact of time. So the assumption is one day goes by, one full day goes by, and that thief comes into your portfolio and steals your money. Here's the thief on the calls and on the puts. Notice, you can't go back in time. So theta over here is always negative, okay? It is always going to erode at the premium. So tomorrow, if you woke up, you would see 6 cents coming out of your premiums on these corresponding calls here, all right? We would see that 6 cents, not 6 cents, 6 cents coming out of these premiums tomorrow, and same for these on the put side. It's always negative because we can't go back in time. So theta is that thief in the night that comes and steals our premium and will ultimately try to erode those premiums down to zero by expiration. All right. And then Vega is just volatility. If you ever just see me write vol, that means volatility, okay? Vega measures the change in volatility and how that is really going to affect our premiums on any given day. We really need to know. This is where I was talking about the environment, all right? Anyway, the environment. So volatility, literally probably the most important Greek to understand, folks, especially if you've been watching any of this GameStop stuff. Volatility was really what was driving those options prices more so than the movement in the underlying. So volatility is Vega. Vega is positive on both sides. And this is Vega as well. Another way to look at it's implied volatility, folks. It's really the thing that I look at on any given daily basis for any underlying. I'm not always looking at the VIX. Yeah, I will look at the VIX, especially if you watch the daily market commentaries that talk about that. But what I'm more concerned about is what XYZ's implied volatility is. I don't care about everybody else's. All of these underlyings will have their own coefficient. And we'll break that down here as we go through this more. But basically, we're talking about an increase of only 1%. So we're talking 27.57 on this. That would be increasing by 1%. We would see this Vega column increase the premiums in correlation, all right? So Vega, we would see 1 percentage point increase would add 19 cents in there. And if you guys were watching GameStop, it was moving at 100 clips at some point. Usually a big move would be like 10 percentage points, okay? And 10 percentage points times this, you can see that that is pretty massive move in the premiums, right? Because if 1 percentage point increases by 18 cents on the puts, well, what's 10 percentage points? It's $1.80, $1.90 over here. Okay, so 10 percentage points increases would increase my premiums by that multiple. All right, folks. Like I said, we're doing this on the long call diagonal, but we're putting that on the shelf right now because we really don't know we want to do the long call calendar on any given day when we walk into the markets. So where are we going? Ultimately, what we're doing is we're flipping through charts. I'm looking at Visa. Yeah, they just had earnings here, so I don't have to worry about that earnings necessarily. I don't really love to put on trades well in advance or in advance of earnings being 10, 15 days. I like to do earnings trade specific for that move. I also, and this is actually one of the stocks or one of the strategies I will use for earnings setup. So coming out of earnings and heading into a new earnings, right? So you got a new earnings coming up. I like to set this strategy up because we would expect volatility to start increasing closer to this event, all right? We can see that the volatility, which is implied volatility, remember I said volatility is implied volatility, that's what we're going to be looking at. We can see has been going on a downward trajectory, but it is pretty close to these lows that we've seen. So having said that, and my assumption is that this underlying is going to kind of trade like that, right? Heading into that earnings. I don't think that it's going to be a massive spike or any of those things. I think that it's going to be a slow trudge. So I'm already starting to come up with an idea here for this type of strategy where I believe volatility will expand here. Volatility is probably not going to go much lower than here. So I'm not too concerned about volatility contracting. I know I'm getting in a low volatility environment. So that's something I'm not too concerned about. But ultimately, I look at the charts and I'm thinking, okay, I think it's going to do something like that. All right. So I've come up with my assumption, right? First thing we come up with is our assumption. And I have a bullish assumption. I could say market neutral is a possibility. I'm not bearish in this stock, so I'm not worried about the downside so much. I do maybe in this case want to protect myself, because it's a long, I've got a long outlook. I don't want too much risk to the downside. I think the market is going to make this bullish move though throughout. So do we have where are we going? Do we have something to talk about? Yes, we kind of are on a roadmap like this where we're going to go for a long duration type of trade, okay? We're going on a long road trip, probably cut across and then see it move higher. So I've got my assumption, what I think. Now we have to figure out, is Visa a good underlying to trade? Meaning, is this spot, a place where there's a lot of eyeballs? Ultimately, what happens when there's a lot of eyeballs, a lot of open interest happening around this underlying, it means the bid offer in these options are going to be very tight. And the reason why that is important is because the strategies, especially with multi-legs and further duration, we need to have a lot of open interest going on in there because it will create that tighter market. If you have to give up a massive edge to get in and a massive edge to get out, well, that's going to eat into your overall yield of your return on your trade. So the last thing I wanted to do is see somebody, we talked about theta, that thief in the night that comes and steals your premium. I mean, if you gave up like 30 cents to get in order to make that up, you're going to have a lot of things work in your favor because you've already put yourself in a hole by giving up too much edge. If you gave up 25 cents to get in, you're probably going to have to give up 25 cents to get out. That's a total of 50 cents. Now, 50 cents may not seem like a big deal, but when you take into account the option contract multiplier of 100, that's 50 bucks, folks. Don't be throwing money around like that. So I like to find the top ones with the tight bid offer. That means they usually have a lot of volume and open interest going on, and I don't have to click on these windows in order to figure that out. So my rule for this is, on the analogy front, staying with the roadmap, let's just throw this out there. So we got the stoplight analogy here, is what I'm looking at. And my rule for this is, let me find something where my rule is you take the decimal on stock that is greater than $100. We basically are going to take the decimal place and move it 3 ticks to the left, or if you can't see that, it might be off the screen. 1, 2, 3. So we're looking at 20.8 cents or whatever. So I'm just going to call it 21 cents. So we want to look at the options that are the spot month. Now, 15 days to expiration. A lot of people are rolling out to this strike here in the March. Why are they doing that? Well, it's because, people like to be as close to 35 days to expiration. 35 days to expiration is really the sweet spot for people to get, call that your spot month. We're about 8 days away from that, but this is way too close for most people to be really trading on any given day. There's still a lot of volume and open interest in there, don't get me wrong, but a lot of that volume has to do with a roll happening out to further duration strikes as well. So less than or equal to the 21 cents, then it needs to be less than or equal to 21 cents after you make that 3 tick move. That would make this a green light, okay? That, if it follows my rule, it's a green light. You can see all of these are 20 cents wide. So we're well within that 10 cents, 11 cents wide, 15 cents wide, 15 cents wide. So it's fitting this rule. So we can say that that's a green light. Now, if it's 2 times the rule, then we look at it as a yellow light, and 3 times the rule, just walk away, especially for newer traders. Don't even bother with trading those options because they're really thin. And if things get wanky and volatility starts spiking or this underlying starts moving around, they're going to get even wider, okay? Because that one person in there making a market is going to determine there's too much risk going on and he's going to make them wider. Now, all of them will get wider as this volatility increases, but, it is a multiple, it feels like, when there's only one person in there trading. Think about it this way, as if you were going to a farmer's market and you were going to buy apples, and there was one person there selling apples. He's probably not going to budge from his price. But if you go there and there's 10 guys selling the same red delicious apples, then you're going to have a little bit more price elasticity there, okay? So the same idea goes in the markets when there's free market price discovery going on, being that there's multiple people in there making markets, right? That will cause people to trade a little bit differently. If you come in and better the bid in a certain strike, then somebody might actually better the offer, start tightening it up because they want to get filled. And somebody might even step in front of you in front of your bid because now all of a sudden they weren't on the bid and they want to get in there. So free market price discovery really starts firing on all cylinders when we start seeing a lot of people trading in these markets. And you can see even really big, expensive stocks get very tight on that bid offer, all right? Now, if it is less than $100 stock, or well, I guess I was just going to drill down on this. We really want to look at those 35 days to expiration, or as close to 35 days to expiration as we can, all right? And obviously these are 20 days away, these 20 days away from that thing, and about 8 days away here. So that's the one we're going to go at. And like I said, move the decimal 3 ticks, 1, 2, 3. We've got 21 cents. Sorry, I've got kid going to soccer practice. So you can see that it is pretty much fitting that rule across the board with Visa on that. All right. So if it is less than $100 stock, like we're seeing here, going back to that analogy of the road sign, right, or the stoplight here, if it is a stock that is less than $100, less than $100 stock, then it's got to be less than or equal to 10 cents wide to the bid offer on the option montage. So we can see here it's fitting that rule for this stock as well. This is Coca-Cola, by the way, just for lack of a better analogy on something that's less than $100. That would be a green light. And if, again, 2 times the rule, if it's 20 cents wide on a stock less than $100, that is definitely a yellow light, and a red light obviously is the 3 times the rule. Okay, so that's what we're looking at when we're going through this process. So I would have already come up with my destination, and then if it doesn't fit this rule at this stage, I need to figure something else out. Maybe I got to go out there and would probably look for a stock that is very close to the one I'm looking at, you know, Coca-Cola, Pepsi, or something else along those lines if it didn't work out for Coca-Cola. Or if, you know, if I was looking at MasterCard and it wasn't fitting that rule, or if I was looking at Discover and I was basing my assumption based on spending habits of the consumer, then I would probably, and I'm looking at Discover, I might just go over there to Visa with that same assumption, okay? So find something like the pairs or whatever of that underlying that has people trading in that underlying. All right, what's the environment? What we're talking about here is volatility. If it's got low volatility, think about it as it's sunny skies. You've got all the time in the world to get to your destination. There's nothing to worry about it. But if it was high volatility, you want to get to that destination as quickly as possible. You're probably going to beeline it. You're not going to make stops at roadside attraction. You're going to straight go there. So, you know, when it's high volatility, we want, you know, low days, less than days, for lack of a better, less than days to expiration. And when you have the low volatility, you want greater days to expiration, all right? Because you want to take your time to get there, all right? That's the idea. Low volatility usually insinuates you're going for the longer duration options. Now, I'm not saying 200, 300 days out necessarily, but I'm saying outside of 35 days to expiration, you know, outside really 75 days to expiration, and less than days to expiration, you know, the ballpark is about 35 days. And we'll drill down on why that's true going forward. But how do we figure out if we have high volatility or low volatility? Well, for every underlying, you heard me say this earlier, every underlying has its own implied volatility range. Now, yes, we still have this whole thing left over from the pandemic. I don't think we're going to see this kind of volatility spike again for quite some time. The last time we saw this kind of volatility spike was in 1987, not even in the financial crisis, and before that was 1929, to give you a comparison as to this type of volatility. And I don't think we're going to see the type of volatility we saw way back at the end of 2019. All right, I think that we're going to see volatility here for probably the remainder of 2021 before we start seeing those really old type of volatilities. I mean, you can even see that show up in the VIX, right? The 20s, mid-20s are the new teens for volatility in the VIX. You know, we used to say when, you know, you'd get up in the teens of volatility, that was high volatility for the VIX. Well, now we've been sustaining that easily, and the 25s are right around that new volatility area. Well, I'm not necessarily breaking that down to here, but we do have elevated volatility across the board. So I'm going to look at data from here on out, all right? So just by putting in these lines in the sand, you can see where I put it, where it has a tendency to, you know, reach and can't go much higher than that are those extremes. And then the extreme lows are right around in here. And we are approaching that quickly, right? So I would say that that's relatively low. Right now, this 28.69 in Visa is relatively low for Visa. Now, if I were to look at Tesla and compare this implied volatility, I bet you Tesla never gets that low. So as a matter of fact, let's just, since I'm talking about it, let's pull up a Tesla and see what it's doing. I had the forward chart up here, Jeff, and I just saw that they obviously are doing pretty well on their earnings because it just spiked. All right, so Tesla on a one-day chart. One-day chart on Tesla. So let me blow this up so it's not as confusing with the writing below. So you can see Tesla, when it gets at extreme lows, is around 60. All right. So Tesla's low is around 60. Its highs are up in the hundreds. Whereas what we, excuse me, I'm going to try and sneeze here, I guess. You can see that 60 is way out in bizarro world for something like Visa. And I'm not going to be able to hold this sneeze back much longer, you guys. It's driving. All right, so I can say that we have pretty solid low volatility just by ballparking it. And I'm going to drill down on that here as we go along. So why is volatility important? Or why does it matter? Because when we talked about the option montage earlier, we talked about as volatility increases by, percentage points, that means those premiums are going to go up. All right. As vol goes up, then our premiums go up. All right. So if you bought low volatility or you bought premiums when the volatility was really low, if the underlying didn't even move anywhere and we saw that volatility go up, we could be making money. All right. Now, in those daily market commentaries I do every single day, I talked about that GameStop move. We saw one day where GameStop moved $200 higher. Well, we also saw in that delta was a 1 delta on these puts I was talking about. We saw a $200 move higher. We would expect puts to decrease in value in that, but we saw the volatility spike by over 100, and the volatility coefficient was 2 cents. So that $200 move, delta is 1 penny. So for every $1 move, the premiums should decrease by 1 penny. But that $200 move higher, my premium should have gone down by $2, but the volatility increased by 100, and my delta was 2. So that's $200 increase in those premiums. It completely offset. Those premiums didn't move at all on that $200 move because volatility spiked. So it was really interesting to watch that through that whole maze of opportunity. And when volatility is high, if it comes out, volatility comes out, our premiums go down. All right. Even if the underlying doesn't move. If you guys watch the daily market commentaries, again, you saw my EA trade. Electronic Arts went against me on my puts, but that volatility coming out offset the directional move. I was able to make money. All right. I love that when that happens. I love it. Like literally, I don't know if there's anything I love more in trading than when that happens. You're directionally wrong and you make money. You can't beat that. All right. Volatility affects option premium. When volatility is high, we sell premium. You want to collect a credit when you are selling high. And when you are buying low, you're paying a debit. All right. Or the expectation of volatility increasing, you would want to buy it. All right. So sometimes volatility is high, but you expect volatility to increase, then, take that into account as well. All right. One other thing with this one, more specific to this option strategy, and we talked about this a little bit in the calendar webinar, because we have different months, right? We're going to be trading in different months here. We want to make sure that our implied volatility coefficients here, or our beta, is not making a major difference. So back to the analogy of the stoplight. We've got a stoplight. Hopefully everybody can see this over on the side. I just don't want to cover up all the things here. Now, a green light is less than a 3% increase, okay? Now, we're always talking about the increase. I see you, Chris. Give me 1 second to read all that. So what I'm talking about, between the 2 months that we're trading, I want to make sure that this number does not, I should say this number, our further duration option contract, does not increase more than 3%. And we can see that that is a 1% increase exactly. So that fits the rule for my less than. Basically, if it's 3 to 5% increase, that's your yellow light, all right? And if it is greater than a 5% increase, walk away. All right? Don't do this strategy around that. Why? Because I am selling an option, I'm selling a call here, and I'm buying a call here. So let's think about it. If I am seeing a major difference in these options volatility, we know that the one that I would be buying, if this increased by more than 5 percentage points, it would mean I'm buying options here. These options here are very expensive, and the ones I'm selling here are going to be very cheap. So I'm selling cheap, I'm selling low and buying high. We don't want that discrepancy happening, okay? And we talked about last week in our call calendar one where we had the example where this number was actually lower than this number, and that is obviously way less than our rule here. So, right, that if you ever see those numbers decreasing, that is a rarity, and then that in that case you would know you were selling the expensive premium and buying the cheaper premium. All right, anytime it goes down. All right. Something also I forgot to mention at the very beginning when we were talking about our roadmap to trading options, in the roadmap key, I should say, we can see here very easily that volatility affects further duration options more. So as volatility expands, those further duration options should feel that more, and the nearer duration options are going to be affected a little bit less. Also, theta, notice theta is much more aggressive the closer to expiration than the further expiration, all right? Even for the same strikes, all right? If I were to look at the same strikes here, that's the 105s, 205s, 205s there, and the 205s here, you can see that the theta is much more aggressive the closer to expiration than those further duration options. And you can see the Vega coefficient is much greater further out than it is closer, all right? Why does that matter? Because we take advantage of those when we're trading, right? I will be able to take advantage of theta in the one that I'm selling, and I'm going to limit theta here, and if volatility expands here, then it's going to be much greater than the volatility expanding in the option I sold, right? So if I'm buying further duration, I'm limiting that theta decay. I'm holding on to the value, but if volatility increases, that volatility in my premiums are going to increase at a faster rate than the ones that I sold. And those ones that I sold are going to decrease in value due to theta faster than the ones that I bought, right? So all of those things are trying to work in my favor. I'm trying to take advantage of the theta contraction in the one I'm selling, limit it in the one I'm buying. I also want to take advantage of volatility expansion in the one that I'm buying. So as an earnings setup, if you're setting this up to where the option you're buying is in the contract that holds or is going to expire after that earnings event, that will see the greatest, that option contract will see the greatest increase in volatility, all right? So that's a way to set this up for an earnings trade as well. So like if you're thinking about ever trading earnings, this would be one right after the earnings happens. The market's making maybe an opposite move of what you believe it should be. And then that would be an opportunity to take advantage of one of these type of strategies because, if the market goes opposite of what your long-term durational aspirations are, then you can absolutely take advantage of that kind of move with this type of strategy, okay? So make sure there's not a huge difference between the 2 months there. All right, so for those of us that like to ballpark it, I can draw the lines here and see that this dot, the last mark, is near the lower range of implied volatility for Visa specifically. okay, we can see that this volatility is relatively low for that range-bound implied volatility for Visa. So I know volatility is low. If you look on it, if you go to the option montage page, and here, I'll just pull it up here. If I go to the option montage page and look at the trade, now I didn't do a trade in Gilead, but you can see implied volatility percent is right here in the statistics. I have implied volatility over here in the watch list. I have the script for that. TOS doesn't do that anymore, I don't think. At least last I checked, it didn't. So you can find this number here for even Visa. If I were to pull up Visa, it's saying 13%. But keep in mind, Visa is, with that script, it's taking into account this high and this low. And remember, I already said, I think that high and low is out of the question. I don't think we're going to see that kind of spike, and I don't think that we're going to see that kind of low volatility going forward. Chris, I'm trying to get to your question, but give me 1 second. Hopefully I haven't gone too fast for you. All right, so we already saw that TOS takes into account this high and low. I want to take that out of the equation. So if you really want to dig into the minutia of the math around this and figure out an exact line, you can take the current IV minus the low IV, take that sum and divide it by the high IV minus the low IV. All right, so you take those two sums. Basically, what we're trying to figure out is where the current is in relation to the high and the low, right? So basically the high and the low and the current. So we're going to say the high here is, let's just say it's 44. The low here is right around 24. And we've got the current line in the sand right there. So current, I'm going to say is 29, just to round it off. Minus the low is 24. Divide that by the high, which is 44, minus the low of 24, right? So we've got 5 divided by 20, and we're looking at 25 percentile. All right. So when I'm looking at this, this really this why we need to know this is this determines our option strategy. Whether we're buying it or selling it, right? If it was extremely high, I would say it was right around 100 or like in the 90 percentile. That would say those premiums are expensive. I would have to be thinking I need to lean towards collecting a credit. But since it's so low, I need to be thinking, all right, I need to do this for a debit. I need to be buying options because the premiums are so friggin' cheap, all right? Or, you know, you can do the ballpark. I have no problem with this. So along the lines of the analogy again, right? What we want to see happen is, if I'm going to do the analogy, I'll just do it this way here. If, you know, if it's above 70, you know, that's an easy one. If it's above 70, you want to be selling premium. If it's below 30, you want to be buying premium. That would be your major green light. But basically what I look at is if it is, if it's greater than $50, or sorry, 50%, if it's greater than 50%, I'm looking to sell premium. And if it's less than 50%, that's a 50, sorry, 50%, then I want to buy it, right? But if you have a lower risk tolerance, just think that if it is, you know, 70, you sell, and if it's like 30, you know, you're buying, all right? So if you wanted to get to the extremes, low risk tolerance or something like that, then I have no problem you using this. All right, if it's above 70, you're selling, and if it's below 30, you're buying. I have no problem. You're pretty comfortable trading or have a high risk tolerance, then go with this one. All right, Chris, as you've said previously, you can be directionally correct, but lose money due to volatility crush and other factors. Yes, absolutely. You know, especially for like earnings, where these guys are talking about on TV, you know, to go out and buy calls before the earnings. if you here's a great point. Look how fast that volatility came out. It basically, let's just say it went from 40 to 28 in a matter of a couple of days. You know, you could even say it went from there, but basically, let's say it went from 40 to 28. That's 12 or 11 if I round it up to 19. That's, 10 percentage points times the volatility coefficient. That could be dollars. So to make up for that, you would have to have a major move in your favor for that delta to offset that. So yes, volatility, there's people that don't understand volatility and they're trading options. And as a matter of fact, a really smart guy recently was talking about this, about the options premiums, and he couldn't figure it out. And it was as simple as going to volatility. But ultimately, this is how you find out in minutia whether or not volatility is high or low. I don't care if you guys do a line in the sand. I'm at a point in my life where I just I can see that this is middle of the road, right? So I know that this is the buy zone and this is the sell zone, right? So what duration are we looking at? Well, we've got one where we're buying the further duration. We want to limit that theta decay, and we've got one where we are selling premium and we want to exploit that theta decay. All right. So basically, this is where you're selling a call, and this is basically where you're buying a call. All right. So you get that massive theta decay happening. This is erosion from those premiums, and this is holding on to that theta decay. So the one that we're selling will decrease in value disproportionately faster than the one that we're buying. And that's what we want to set ourselves up for, success. And that is how you do it when you're building an option strategy. So what vehicle do we use? Well, that's the long call diagonal. Because of the fact that the difference between the long call diagonal and the calendar, we expected a sideways to maybe slightly bearish move and then a rebound. This one, we are believing that the market is just going to maybe have an upward trending trade there, all right? So what spots do we visit? Well, if you go online, they're going to tell you, well, you sell, maybe, I don't even know if they're going to give you this kind of information, and get long the in the money further expiration. They're just going to tell you, you sell one at the near duration, you buy one in the further expiration. But I go further. I'm going to talk about this. If is an ish, all right? When we say ish, it's not exactly, you're not always going to get the exact same delta, all right, ish. So that's where we're starting point from. And I like to pick this one first, the in the money, long duration expiration, 84-ish delta, and then I start building from there. And what happens is, on the Analyze tab, it will look like this. You're going to have a flat off top because and this is during the life of the front month, all right? This is during the one that we sold here. If, we let that one expire worthless before expiration or take it off for maybe a couple of pennies or nickels, then our trajectory to the upside continues, all right? Then it becomes unlimited after this, if this expires, or short call expires, all right? And we're limited to the downside because when you buy a call, you have no more limit, you have no more risk below that strike. So anytime you're buying an option, you have limited risk. So that's the beauty in this strategy too, versus going out there and buying the underlying and trying to do a covered call or something. You have limited risk to the downside. All right, so you guys have got this. Direction, we came up with a direction, and then we started looking for our underlying. XYZ, or in our case, was equal to Visa, and we looked at our Visa trade. It's trading 208. So what do? Move the decimal 3 ticks to the left, right? And that makes it 21 cents. We know whether our bid offer needs to be within that range. Environment. This is implied volatility percent, and we got low vol, right? Duration. Well, we're buying a call and we're selling a call, right? We want this as close to 35 days to expiration as we can, and we want this one about 70 plus days to expiration on the one we're buying, days to expiration. And then the strike, we start out with around an 84 delta, and then the call we're selling, we want that to cover, we want that to pay off all the extrinsic value. I'm not gonna. All right. So that's what we're going to try and do by building this strategy out. And with this, I'll show you how to do that real quick before we start moving on. Does this make sense? Oh yeah. Sorry, I thought there was a new question up there. All right. So what do I want to do? I want to go to my trade platform. So let's just look at the trade platform. So for instance, I would be going into this. I looked at the charts. We already went through all of that, right? You can see volatility came out just ever so slightly. Didn't really move a whole lot from where I was looking at. So I'm probably going to be looking at the same. So 15 days to expiration, that's a little bit too low. Let's go 14. It's probably not going to be enough. The June is going to be my further expiration. Why? Because I don't have the one that's in between there. So I'm just going to change this to 20 strikes so I can get all my strikes in there. All right, so 84-ish delta. I'm going to go with this one, right? That's the one that's closest to it. Now, I'm going in here. I bought the 75 strike. How do I pay off the extrinsic value? How do I even know what the extrinsic value is? Yeah, you can do the math, subtract it, say 75. 25, so $34 or whatever. There are other, the difference between 175 and 208, or let's say 209, is $74, right? Or sorry, $34. Well, you can see the premiums here are much more than that. Well, do a little floor trader hack. You look over here and see that these premiums are right around $3.50. You can go in here and say, all right, well, I'm going to sell these. You want to try and pay off all that extrinsic value. That's going to be close. We're going to have to look at it. So if I added $33 into this, we can see that $34 into that, it would be trading right around 209. So I can see that I paid off my extrinsic value, right? Because 34 plus this gives me 209. So I'm just slightly below it, which is good. That means I paid off the extrinsic value. Next thing I need to do is look at the difference between the two strikes and figure out I want to pay less than 75% the width of those strikes. So the width right now, we're looking at 44. So I take 34 divided by 45. 34 divided by, so right there at 75%. So I would say that that's as close, I mean, that's close enough for government work. That strategy would work, okay? So less than 75%. If it's basically 75 to 85%, that's really a yellow light. I would be very cautious going much further than that. So, with that analogy, 75 is the green light, less than 75, percent width, the debit, 75% the width, that's the green light. All right. All right, so what's our max, what's our max profit on this? It's the width of the strikes minus the premium. All right, I showed you that. Or I'll show you that here on this. The width of the strikes on this example is $50 minus 37. So $50 minus 37 is, or 37 and a half is, what is that? $12.50. So my max profit on this one is the width, $50 minus the 37.68. Our max profit then is that difference. So we're talking about $12.50-ish. would be our max profit. And our premium paid is our max loss. So that $37 times the contract multiplier, so $3,700, the most I can lose, $3,750. And our break even is the long call strike. Whoops, I don't want that. Long call strike minus the, long call strike plus the premium pay. That's our break even. I showed you in this example, why'd you go there? I'll go one more. There we go. So breaking this down, the break even is the long call 170 plus the 37. That puts me at 108 in this 108.68. You can see 108.68 is my break even here, or sorry, 107.68. 207. Been a long day, I guess. 37 plus 170 is 207.68. You guys can probably see me blushing. The underlying is currently trading at 208.19. So my break even is below where the current underlying is trading, right? Now, my max profit is the difference between the width of the spread, which is 50 in this case, plus that. So 17 and a half, or sorry, 12 and a half. So you can see here, this is looking at $1,250 there. My max loss is $37.68. All right. So playing that to the upside. Now, another thing we got to look at is our exit strategy. On a winner, I want 50% of max profit. All right. So we looked at that just a minute ago. It was $12.50, $6 and 75 cents, let's just say, is my max profit that I'm going to take. Well, I was paying $37.68, right, plus $6.50. Now we're looking at $34 and 18 cents. Sorry, what am I doing? $44. Spiraling out of control. So when my spread is worth $44.18, that's basically where I'm getting out of a winner. A loss, I would look at it as 50%. You know, if my debit goes down by 50% decrease in my debit, then I'm going to pull the ripcord and get out of this trade on my long call diagonal is how we would write it on the floor. Actually, we'd write it like this, long call diagonal on that. And that's my, what was it? The 230, they were the 170s and the 220s, right? I'm going to sell or buy the 170 calls, and I'm going to sell the 220 calls. And this was in, I think, June or something, and this was in March. Okay. You guys have any questions there? But write all this stuff down, folks. Why? Because it will help you keep mechanical, especially on your exit here. Figure out what your max profit is. Take 50% of that max profit here. Add that into what you originally paid. That's where your target is to get out. And if this underlying shoots up right to this 20, immediately, it's probably not going to be a 50% increase in your max profit. That's another key to get out is on a winner. If it trades during the life of my short strike, trades 220, just get out. You're going to have a profit. It's gone up there, hit your short strike. Just get out of it so you don't have to deal with having a short call in there. Yes, you will have assignment risk on the short call if it goes in the money, but you got a long call to offset it. Problem with that is it's going to cost you about $40 to flip through all of that garbage, and just avoid that. Just get out of it as soon as it hits your short strike. All right, folks, I'm going to wrap it up with that. Earnings with options. I have over 10 hours of content in here. I'm throwing this in the chat window for you guys. You can hit on that link. It'll send you directly to this. You guys are going to be able to immediately spot the best option strategies for these big moves in earnings. I'll show you when, where, and why we put these strategies on. talking about the days before that happens. All of those things, I will give you finite details as to how to trade those options specifically, and for the options that are coming up, or the earnings that are coming up. And for $36, you guys, if you're watching people on TV, they're telling you to buy a call for an earnings, that volatility crush coming out of that underlying on a long call, even if you're directionally right, you could be looking at it like, I took all that risk and didn't make any money. And that's more frustrating than anything. Like I said, the link is in the chat window. If you want to type this into your URL, you can do that. Please feel free to call us 310-598-6677 or trading@protraderstrategies.com. Like I said, well over 10 hours of content. You can easily click on it over there in the chat window. And, you know, if you guys like this video, you know, pass it on to a friend. Give me a thumbs up or a like button. Also, if you have any questions, comments, or want to chat, hit me up down in the chat window there. I'll be happy to comment and talk to you guys about it. All right. Finally, know your risks, know your reward, know what you're getting yourself into, especially these days. SEC is clamping down on people giving advice on trade recommendations. I don't give trade recommendations. This Visa is not a trade recommendation. It is a hypothetical trade that we can build based on an assumption that we came up with. I'm not necessarily putting this Visa trade on tomorrow, you guys. I'm just talking about how we come up with this strategy based on our assumption. So I don't know what your guys' risk parameters are, all those things, so I don't want to get involved in that. So please take a moment to go over this disclaimer. You may need to pause and read over all of that. All right, so like I said, earnings with options, take advantage of that. Please check out my daily market commentaries. Follow us on Facebook at protraderstrategies.com or on YouTube at protraderstrategies.com. We throw out all kinds of content there on a daily basis, so check that out too, please. All right, that's all I got for you folks. Bye for now, folks. Thanks, guys, for all the kind words. Appreciate it.